This is The Markets. I'm Chris Hussey, and today is Friday, March 6th, and I'm here on the Goldman Sachs trading floor with Josh Schiffrin, who is Chief Strategy Officer and Head of Financial Risk for Global Banking and Markets. Josh, thanks so much for joining us.
Nice to be with you today.
What a week and what a day again. We just got payrolls, came in weak. What do you make of the number? What do you make of the market reaction?
I think it was a clearly weaker than expected number, maybe noisy due to, the birth-death model, weather, and other potentially more transient factors. It's only 1 month, but I do think it was a weaker than expected number. I'm most focused on the unemployment rate, which ticked up to 4.4. I think that's a extremely key variable to watch. I also think that's not the market's focus right now. The market's clearly focused on geopolitics, energy markets.
All right, so let's jump to the geopolitics and the energy markets, because that is the story still. It's even overshadowing the payrolls report this week. What is the situation today as you see it now? Are we getting to a pressure point because of the amount of time this geopolitical risk has been elevated, or is it something else?
Geopolitics are clearly in focus. I think that the uncertainty bands have widened materially, but I think the key thing is themes this week have been counter to that from the first 2 months of the year, which was characterized by expectations of strong growth, inflation returning to target, and the possibility of further Fed easing. I think that higher oil prices clearly complicate all of that to varying degrees. It hurts the growth outlook. It increases the inflation outlook, and it also puts pressure on a theme of moving out of U.S. to the rest of the world. High energy prices hurt the rest of the world relative to the U.S. And I think all of those factors run counter to the themes of the first 2 months.
That's a great point. So we've got the geopolitical risk is now potentially impacting growth and inflation. We've seen the unemployment tick up. Seems like everything is growth negative right now. What do you make of the state of the economy today?
Certainly more worries than a week ago. Just one jobs report and some of the other indicators this week, whether it was non-manufacturing ISM, were clearly stronger. Oil prices, up very sharply this week, adds, a clear complexity to the inflation picture. It's clearly just overall gotten much more uncertain. And we'll have to see in particular, how the geopolitical situation plays out. I didn't think, the collection of data this week was, so demonstratively negative for the labor market that it broadly changes the outlook. But the payroll report was weak. But it's one report, and I think it ups the ante for the next one.
So let's unpack that a little bit too, because normally when we get a little bit of a growth shock, and now we've seen unemployment tick up and we've got inflation ticking up, the Fed comes to the rescue. But it's a complicated Fed because we have sort of a stagflation situation now developing. What is the Fed's next move?
It certainly gets more challenging, particularly given inflation having been above target for some time, now potentially, an additional inflationary shock. I still clearly think the next move is a cut. I don't think an oil price shock in and of itself would lead them to hike, but I think it complicates the overall picture and when those cuts might occur and at what pace. Anytime you have a shock that increases inflation and maybe decreases growth, it becomes more of a challenging situation for a central bank.
So let me talk to you about positioning in the context of all of this a little bit, because as you pointed out, the themes totally turned on their head. What was working hasn't been working, and the themes have been dominated by oil. Where do you see positioning today now?
I think certainly, there's been positioning reduction this week. I think some of the moves this week have been, hard to explain. Gold not rallying, in spite of, a clear increase in geopolitical tensions. I think some of the moves have been, reductions in the year-to-date winners. I think there's been some position reduction. But I think if the conflict extends and the recent moves persist, I think there's certainly the possibility for more.
Right. So a lot of this has to do with how long the conflict lasts. In the meantime, where should you be focused on? Is it oil? Is it rates? Is it FX? Is it stocks? Where do you like to focus here?
Well, I think we should focus everywhere, but I think all markets are volatile and active right now. I think oil is clearly the driver. Increasing inflation concerns, natural gas markets as well, and kind of the knock-on, effects to all the other markets. I don't think there will be an unaffected market, but I think oil is, if you had to pick one, that would be the one, to be keenly focused on, whether the move sticks, persists and increases, or reverts. And I expect it to be a volatile time and a fluid time for global markets.
Is it a time to trade, or is it a time to hedge? And if it is a time to trade, what's your favorite trade?
I think it's generally a time to kind of keep things closer to home, appreciating that uncertainty is extremely high. It's a very hard situation to have a strong read on how it will evolve. So I think it's generally a position to keep things closer to home and only trade on things you have like a strong long-term conviction on. For me, when I look out, like one thing that I continue to believe in is the U.S. curve will steepen over time. I think the 2s10s curve has capacity to steepen out over time.
Looking ahead, is there anything to keep your focus on other than the conflict?
I think the conflict, is the clear, epicenter for markets and market focus, and that's what I'll be watching.
Josh, thanks so much for taking the time with us.
Thank you guys for having me.
That does it for this week's episode of The Markets. I'm Chris Hussey. Thanks for listening.
The opinions and views expressed herein are as of the date of publication, subject to change without notice, and may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. The material provided is intended for informational purposes only and does not constitute investment advice, a recommendation from any Goldman Sachs entity to take any particular action, or an offer or solicitation to purchase or sell any securities or financial products. This material may contain forward-looking statements. Past performance is not indicative of future results. Neither Goldman Sachs nor any of its affiliates make any representations or warranties, expressed or implied, as to the accuracy or completeness of the statements or information contained herein, and disclaim any liability whatsoever for reliance on such information for any purpose. Each name of a third-party organization mentioned as the property of the company to which it relates is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. A transcript is provided for convenience and may differ from the original video or audio content. Goldman Sachs is not responsible for any errors in the transcript. This material should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Copyright 2026 Goldman Sachs. All rights reserved.